I can say that. These are costs associated with borrowing. These are costs associated with. These are costs associated with borrowing. E.g., interest, and flotation cost, interest and flotation cost, interest and flotation cost that an entity incurs, in connection with borrowing, Actually, flotation costs are also known as the issuing cost. Yeah, the cost you incur in the process of raising the new funds. Then I have to say that borrowing cost is directly attributable to the acquisition, construction or production of a qualifying asset. Acquisition, construction or production of a qualifying asset. Now, what do you mean by qualifying asset? Now, if you take a loan of 1 million, maybe to buy an asset, maybe land or something else. Now, what you purchase or what you acquire or what you construct using the borrowing money is what you call the qualifying asset. Then I say that. You see that? Borrowing cost should be capitalized. Borrowing cost should be capitalized. Borrowing cost should be capitalized to qualifying asset. Should be capitalized to qualifying asset. And other borrowing costs should be expensed. And other borrowing costs should be expensed. I'll come to explain how you treat. Yeah, whenever you're treating the borrowing cost, we have those expenses which qualify to be capitalized and those which qualify to be expensed. And what we need to be capitalized? Now, for example, let's assume that you took a loan of 5 million to construct a house, and then you spend the entire 5 million in construction of that house. Now the question is, how much will be the value of that house? How much will you recognize based on your understanding? You recognize an amount of? So in this case, you'll take 5 million, but remember this million, you are not just given for free. You'll pay back with some interest. So that interest also need to be capitalized. You will not say that, you say you'll not pay back 5 million. You'll pay like 6.5 million. So that means the interest incurred on that item need to be capitalized here. You add that interest of 1.5 so that you show the value of the asset as 6.5. You won't show the 5 million. So this cost you incur, that's what we mean by capitalization. Now let's look at examples of borrowing costs. Examples of borrowing costs. Number one, interest expense. Number two, flotation cost, e.g. legal cost. Flotation cost, e.g. legal cost. Number three, principal amount. Yeah, that means the actual amount you borrowed. Another one, exchange differences in case of foreign currency transaction. Exchange differences in case of foreign currency transaction. Yeah, sometimes you can borrow maybe in US dollar, but you need that amount in maybe home currency. So in the process of exchanging from one currency to another currency, those exchange differences, you also need to be part of borrowing. Another one, amortization of discount or premium relating to borrowing, relating to borrowing, or premium relating to borrowing, or premium relating to borrowing. So I want us now, we define qualifying assets. We define qualifying assets. Right to see that? It's an asset that necessarily, takes a substantial period. It's an asset that necessarily takes a substantial period of time. It's an asset that necessarily takes a substantial period of time to get ready for its intended use, to get ready for its intended use, for its intended use. So examples of qualifying asset include examples of qualifying asset includes number one, manufacturing plant. Number one, power generation facilities. Number one, intangible assets. Another one, investment property, etc. Now let's look at accounting treatment. And recognition of borrowing costs. So how do we treat borrowing costs? I'd like to see that. An entity shall capitalize borrowing costs. An entity shall capitalize borrowing costs. That are directly attributable to the acquisition, comma, construction or production, or production of a qualifying asset, as part of cost of that asset, as part of that cost. That's what we mean by capitalization. Yeah, so you think that in this case, this borrowing cost and interest will be included as part of value of that asset. So you take the principal amount, 5 million, then you add the interest, then you capitalize it, so that now you show the value of the asset as 6.5. Another point. See that? An entity shall recognize other borrowing costs. An entity shall recognize other borrowing costs, such as legal fee, as an expense in the period, in which it incurred them. As an expense in the period in which it incurred them. Simple. So you're saying that borrowing costs I've given you on how to account for it. That borrowing costs need to be capitalized and others, they need to be expensed. Good. Now we look at something else. Borrowing costs eligible to be capitalized. 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 Let me say that. Interest cost will only be capitalized. Interest cost will only be capitalized. Interest cost will only be capitalized as part of the qualifying asset. Interest cost will only be capitalized. As part of the qualifying asset. As part of the qualifying asset during the period of active construction, during the period of active construction during the year, during the period of active construction during the year. What does it mean by that? Now, this is what I mean. Assume that you borrowed 5 million as at 1st of January. Let's assume 2022. And then you want to prepare your financial statement as at 31st of December 2022. So you took a loan of 5 million as at 1st of January 2022, maybe with an objective to construct a house. And then the construction started on 1st of March 2022. So that means there is a period of 2 months. That's what called the pre-construction. In that case, the interest incurred, actually what will happen, the company or the entity, you don't have to pay the interest for the entire year to the bank. But the question is, how do you treat that interest? Now, the interest incurred prior to, that means it was inactive. The qualifying asset has not started. Now, this interest shall be expensed. Then the interest now that you incur during the active construction period of a qualifying asset, now this is what you capitalize. And that's what I mean by interest cost will only be capitalized as part of the qualifying asset during the period of active construction. Can you understand the word active? Then write another sentence, another paragraph, another bullet, write another bullet. That was the first point. The other one, interest cost incurred before commencement, interest cost incurred before commencement, and during inactive period, should be charged to profit and loss account, should be charged to profit and loss account. Another point. Interest income earned from temporary investment. From temporary investment of surplus fund. Interest income earned from temporary investment of surplus fund should be deducted from the cost, as from the borrowing cost, should be deducted from the borrowing cost, eligible for capitalization, from the borrowing cost eligible for capitalization, What do you mean by that? I think we had borrowed 5 million, and then at the commencement, you only invested 2 million. I mean, you only used 2 million. That's what you put on site. Then the remaining 3 million, because you knew that it was not required immediately for the project, you decided to invest them, maybe on a treasury bill that will mature in 3 months. So that means what you had borrowed, some amount which was not required immediately, that's 3 million, you decided to invest them. Now, remember this period, there is an interest income you earn. Now, that interest income will be offset against the interest expense which qualifies to be capitalized. Another point. Interest earned during the pre-construction, and inactive period, should be excluded from determination of borrowing cost. should be excluded from determination of borrowing cost, should be excluded from determination of borrowing cost to be capitalized. Borrowing cost to be capitalized. Borrowing cost to be capitalized. Yeah, that's how you treat that. And you can actually see that. When a qualifying asset, another paragraph, that's a totally different thing, another paragraph. When a qualifying asset is financed by more than one debt amount, is financed by more than one debt amount, is financed by more than one debt amount, comma, the cap interest rate will be determined as follows. Now, the cap interest rate, in this case, will take the aggregate interest payable. You divide by the aggregate amount borrowed. Now, before you copy this in here, now assume that for the construction of this house, let's assume that of the 5 million, 2.5 million you borrowed maybe from Equity Bank, maybe at the rate of 13%. Then the balance of 2.5 you borrowed maybe from KCB, maybe at the rate of 16%. So in that case, remember the full amount of 5 million will be used in construction of one asset, that qualifying asset. So in such a case, so how do you determine the cap rate that will use to determine the interest to be capitalized? Now this is what you'll do. You will take the aggregate interest payable, you divide by the aggregate amount borrowed. You can copy that. So another paragraph I want us to look at how accounting treatment under IPSAS. Now IPSAS is this one is International Public Sector Accounting Standard. It's accounting for the government entities. Yeah, how the accounting treatment under IPSAS differs from IAS 23. Actually, most of the IPSAS and IAS, when they are talking about the same item, almost they are almost the same actually. They are equally the same. But sometimes there might be a slight difference. So in case when you're accounting, now let's assume you are financing a government asset. Because for government asset, for the public sector entities, that's when you use IPSAS. For the other commercial entities, that's when you use IAS. So what's the difference in the treatment of the borrowing cost, which is different in IPSAS away from IAS 23? Where is that? You see that? IPSAS 5 requires borrowing costs to be expensed immediately. IPSAS 5 requires borrowing costs to be expensed immediately, in the period in which they are incurred. IPSAS 5 requires borrowing costs to be expensed immediately in the period in which they are incurred, regardless of how the borrowing is applied. In short, for IPSAS, you expense everything. And then what to say that? Under IAS 23, the revised version, under IAS 23, the revised version, requires that borrowing cost requires that borrowing cost requires that borrowing costs that are eligible, borrowing costs that are eligible for capitalization requires that borrowing costs that are eligible for capitalization should be capitalized, and included, shall be capitalized or should be capitalized and included as part of qualifying asset, and included as part of qualifying asset, included as part of qualifying asset. Yeah, so that means under IPSAS, we don't capitalize. Yeah, by IPSAS, we expense everything. But from the IAS 23, that's when you capitalize the part of the qualifying assets. Let's do an illustration. December 2022, question 3B. December 2022, question 3B. December 2022, question 3B. December 2022, question 3B. Now, the need to that Sayari Limited obtained a 10% loan note amounting to 24 million on 1st of January 2021 to finance the construction of a new factory. As the funds were not all required immediately, Sayari Limited invested 10 million in 6% bond until 31st of May 2021. Construction of the factory began on 1st of March 2021. However, due to an expected shortage of skilled labor, the project ceased during the months of July and August 2021. By that 1st December 2021, the project was not complete. Required. Explain with suitable calculation the accounting treatment of the interest cost on the loan note in the financial statement of Sayari Limited for the year ended that 1st December 2021 in accordance with International Accounting Standard IAS 23 borrowing cost. So kindly I want you to read that question and you read it to understand, not to finish. Kindly read that question to understand. So that when I ask you of some questions, mninyamazie. So now we want to determine how much will be the cost which will qualify to be capitalized. So we determine the net interest to be capitalized. So we take the interest expense to be capitalized. Now, when we took this loan, 1st of January. When did the construction began? 1st of March. That means we began after how many months after borrowing? 2 months. So that means the pre-construction, there was 2 months? 2 months. So the interest for the past 2 months will not be capitalized. Are you together? Then we are told that there was an unexpected shortage of skilled labor, and the project ceased during the month of July and August. So it ceased for how many months? 2 months. Now that means by the end of the year, the period of active construction was for how many months? 8 months, correct. So you'll take the interest rate was 10%. We had borrowed 24 million so that you determine the total interest for the year. But now the interest which qualifies for capitalization is only the interest incurred during the period of active construction. So January, February, that was the pre-construction period. The construction had not begun, so that interest will not be capitalized for the first 2 months. Then there was period under suspense. That means the month of July and August. So that means the only period of active construction was 8 months of the 12 months. So how much will be the interest expense which will qualify for capitalization? Sorry? 1.6. Then you raise interest earned on temporary investments. You deduct the interest earned on temporary investment. And we are told that, second paragraph, as the funds were not all required immediately, Sayari Limited invested 10 million in 6% bond until 31st May 2021. So that means we invested for how many months? Miezi ngapi? 5 months, right? Yeah, that means from January to May. So interest earned. So for the interest earned, we invested temporarily 10 million to earn 6% of 10 million. For how many months? 5, not 5. We invested from January, right? Till that first May, right? When we began the construction? We started March. Now, this period before the construction, it's up. I think I mentioned that one in our notes. There is something I mentioned about any interest earned during the pre-construction and during the inactive period will not be used to determine the amount to be capitalized. So that means you only capitalize. The interest income will only be capitalized only the period of active construction. That means from 1st March to that 1st of May. How many months? 3 months. Good. 3 over 12. With 6% of 10, 3 over 2 should be having an answer. Sorry? 150. So net interest to be capitalized, therefore, will be an amount of, is that 1450? As it was that. Or alternatively, you can do this. You take the interest expense for the period. The interest expense for the period is 10% of 24 million. That means during the year, supposed to pay interest of how much? Then you raise the Pre-construction period interest expense. 10% of 24 million, you get the total interest for the year. We began construction on 1st of March. So that means the pre-construction period is January and February. 2/12. How much is that? Sorry? 400. Also, you also deduct the interest expense during the suspense period. During the month of July and August, there was no work in progress. So it's 10% of 24 million, you get the total interest for the year. Then we want to determine the interest for the 2 months during the suspense, 2/12. You get still an amount of 400. So that means how much is the interest expense eligible to be capitalized? An amount of 1600. That's what we have done there. Then we deduct interest and on temporary investment. Number one, there was interest and during the period. Now we invested temporarily 10 million. For how many months? 5 months. So it's 6%. We invested 10 million for 5 months. 5/12. So that means how much was the interest earned? Sorry? 250. 250. Then you raise pre-construction period interest income. 6% of 10 million. So you eliminate the interest during the pre-construction, January and February. 2/12. So what do you get? 100. So the total interest earned is 250, but during the inactive period was 100. So that means how much was the interest earned during the active period? 150. Now this 150 is now what will qualify to be deducted from the interest qualifying to be capitalized. So therefore you take the total interest expense, you raise the interest earned, you offset against the interest earned during that period. And that's how you get the interest expense. An amount of expense, an amount of 14. So that means now when recognizing an asset of this kind, though you have not yet completed, when you complete, if assuming you completed it during the year, you could have taken the full 24 million and then you add 1.45 million. Now what you could have gotten here is what now you can recognize as part of non-current assets. Good. Now let's try another illustration. September 2021. Sorry, we'll go to September. Should do. Yeah, September 2021, question 4A. Question 4A. Narubin Limited has provided the following schedule of its long-term loans for the year ended that 1st of December 2020. So we have as at 1st of January 2020, that's at the beginning of the year, then as at that 1st of December 2020. So there is 10% loan, that means will mature at 2025, 12% bond, 2028, 6% debenture will mature in 2024. So in this case, we have 3 dates. Additional information. The 10% loan note and 12% bond were used to finance construction of power plant. Can you understand that? Construction of power plant. Yeah, so that means for us to construct the power plant, we used 2 debts, 10% loan and 12% bond. So we say that in case the qualifying asset is being financed by more than 1 debt, so how do you determine or how do you get the average cap rate? So to get the cap interest rate, where the qualifying asset is financed by more than 1 debt, you'll take the aggregate interest payable. You divide by the aggregate amount borrowed. This is what I mean. So for the construction of power plant, we are using the 10% loan note and 12% bond. So you'll take, first of all, get the aggregate interest payable, you'll take 10% of the loan note, and the loan note amount is 300. Then you add, there is 12% bond. 12% bond, and the bond value is an amount of 200. So that you get now the total aggregate interest payable. Then you divide by the aggregate amount borrowed. 10% loan was for 300 million, and then for 12% bond was 200,000. Then you multiply by 100%. That is 30. That is 24. 54 divided by 500 and the 100. 54 you divide by 500. %. Good. Additional information. And she's saying that number 1, the 10% loan note and 12% bond were used to finance the construction of power plant, which commenced on 1st of January 2020. So it commenced immediately upon borrowing. Expenditure for the construction was drawn with 100 million being drawn on 1st of January 2020 and 75 million on 1st of July 2020. So now we first of all determine the borrowing cost on So we use the first 2 debts to construct the power plant. So we want to determine the amount of interest which will qualify for capitalization. So we are told that now this is the rate we'll be using, 10.8. So we are told that the second sentence of the first paragraph. Expenditure for the construction was drawn with 100 million being drawn on 1st of January 2020. So that means from 1st of January 2020. So what we invested at the beginning, that means we'll attract the interest for the entire year. So we'll take 10.8% of the first 100 million. You get the total interest for during the year. Since we invested as at 1st of January, to get the total interest for the year, that 800? 800. Then we are told that, and 75 million on 1st of January 2020. So invest an additional 75 million on 1st of July 2020. Yeah, so from 1st of July 2020, how many months of the year? So 10.8% of 75, but for a period of 6 months. Get an amount of how much? Sorry? 40. So that means how much is the interest which will qualify for capitalization? 14,800. Number two. The 6% debenture was used to finance the construction of new storage facility. So there was another asset. Storage facility. It's another asset. Actually, you only use one debt, the 6% debenture. So the 6% debenture was used to finance the construction of a new storage facility. The construction commenced on 1st of January 2020, so immediately, but no construction took place between 1st of March 2020 to that 1st of May 2020 due to COVID-19 restriction. So that means there was a period of inactive. How many months? How many months? 3 months. The facility was available for use on that 1st of December 2020, having incurred the construction cost of 60. That one invested in full. So now, in this case, we used 6% debenture. So therefore, the interest will be 6%. How much did we invest? We invested the full amount, an amount of 60, so that you get the total interest for the year. But we only capitalize the interest expense during the period of active construction. So due to COVID-19, there was a period of suspense. For how many months? 3. So that means the active period was only for 9/12. How much is the interest cost which we provide for capitalization? 27? 2,700. Good. Required. In line with the provision of IAS 23, borrowing costs determine, number 1, borrowing costs to be capitalized for each of the project as at that 1st December 2020. We already have that. Number 2, the value of the asset in the books of Dalbini Limited. So when preparing the financial statement, we constructed a power plant. This part of non-current assets. Storage facility is part of PPE. How much will show? So number 2, the value of asset. So here we have the power plant, and here we have the storage facility. So here we take the amount invested. Remember, this one by the end of the year was not complete. So that means we have not invested everything, right? So by the end of the financial year, how much have you invested in the power plant? We invested 100 million, right? Then as far as July, we invested additional 70. So how much are you investing in that project? 175. What about for storage facility? We have invested the entire 60. Then you factor in the borrowing cost. And these were the borrowing costs. Here you capitalize 14,850. Here you capitalize 27. So that means now in the statement of financial position of an non-current asset, they show an amount of how much? 1,895.50, and this one is show an amount of 62. 700. Good. Now you can copy. Yes. But what it means is that after now completion, how do you treat the interest expense? You see now, for example, in this case, we have invested the entire 60 million and we have capitalized. But the interest, remember this one was to mature some years later, right? What about the other years? We'll be paying the interest on a reducing balance. Now that interest we don't capitalize. That interest we expense them directly. Are you together?